So good afternoon, good morning, everybody, from wherever you're joining us. Thanks very much for being with us today, and welcome to this webinar of the Finance for Development Lab, or FDL, on debt challenges for developing countries in an uncertain world. I'm Seema Kamourié. I'm the Executive Director for Climate at the Finance for Development Lab, and I'll be your chair today. I'm joined by two of my colleagues, Martin Kessler, Executive Director of the Finance for Development Lab, and Mélina London, Senior Economist at FDL. For those of you who are not familiar with FDL, we're a development economics think tank based in Paris. The purpose of our webinar today is to discuss FDL's March 2026 publication on external debt pressures for developing countries, which is based on the 2025 vintage of the World Bank's International Debt Statistics, and it offers a differentiated diagnostic of developing countries' debt challenges. In light of this analysis, what could be appropriate policy responses? And how does the ongoing conflict and disruption in the Middle East change things? So these are the main questions we will be addressing today. We have about an hour and 15 minutes together to do so. Mélina will start and walk us through FDL's analysis, after which Martin will discuss policy options. And we will then hear from our distinguished panelists, whom we're delighted to have with us today. So thank you very much to our panelists for being with us and for making the time. And after this, we'll have about 20 minutes for questions and answers, and Martin will wrap us up. So without further ado, Mélina, the floor is yours.
Hi everyone, so many thanks for joining us today. So I will guide you through the main messages of our recent publication that was co-authored with Ishac Diwan and Thomas Morgan, based on the latest vintage of the World Bank International Debt Statistic as explained by Seema. So this study is retrospective by nature because we use the latest available data, and you all know how working with data means working with some delays. But we believe it's strongly necessary to understand with the ongoing situation what are the fault lines along which the conflict is currently unfolding. So understanding how the different countries in the low and lower middle income countries group that we're focusing on, how they arrived at the start of the crisis. So let me start with the first lesson on that we can extract from the World Bank International Debt Statistics. First, if we look at the net transfers data, so net transfers being new disbursement minus debt service, so it's the new money arriving in a country. What we see is that in 2024, the situation improved compared to what we had in 2023. So what you see on the graph is the net transfers in aggregate for all the low and lower middle income countries. And what we see is that in 2024, we're back in positive territories, meaning that external debt is a resource for financing for the group of low and lower middle income countries in aggregate, while in 2023, it was a net drain. We see, however, that we're still very well below historical levels in terms of absolute values. And when we look at the dash curve, the dash line, which is a number of countries with negative net transfers, we see that in 24, we still have the same numbers of countries with negative net transfers. So we had a change in absolute values, but not that much in terms of countries classification. So whether external debt for you is a resource or a drain. So we have some improvements regarding net transfers, even though limited. But another big improvement that we've been seeing for the last 2 years is the access to the Eurobond market for for some countries in our groups. We see that after 2 years of being completely cut out of the markets, we have more and more countries that have been returning to the market, first in 24, but also in 25. So that's a sign of improvement. However, Further from this apparent easing, what we also see in the data is that we have persistent vulnerabilities. We have some headwinds that are common across all the countries in our group of interest. First, as you see on the chart on the right, we have higher interest rate on new loans, like showing that we have rising borrowing costs, which you see is both for private, so bond market, but also other private creditors, and as well for concessional financing. So it's costing more and more to low and lower middle income countries to finance themselves with external debt. Another common headwind is what we call the leakage of multilateral flows. So what we see when we look at the data by creditor is that many countries have negative net transfers towards private creditors and towards China. It means that they're receiving less money, less new loans from those two creditors, and they have to use extra resources to repay past debt. And which type of resources are they using? Well, they're using money from multilateral lenders. Well, which is an issue because instead of financing directly growth in the countries of interest, what we have is that the multilateral lending is financing legacy creditors. Finally, another big headwind is also the foreign exchange vulnerabilities. And we've seen how this has been unfolding in the last weeks with the crisis, and I think we'll be able to talk even more during our panel. But we have mounting foreign exchange vulnerabilities with a lot of depreciations and falling reserves in some group of countries. So that's a bit of first analysis that we can make out of the World Bank data. But what we've been doing in this publication is to add an extra layer of analysis by focusing on diverging trends among countries in our group. How have we been doing this? Well, we have applied a double perspective. One is the debt sustainability assessment that we do with the FDL internal model. And the second one is the current access to the Eurobond markets for countries in our group, whether they've been able to issue some sovereign bonds. What I mean by debt sustainability assessment is the assessment of the risk of insolvency. So here, what we assess with the model is whether the country is following a sustainable pathways in terms of debt stock. And we also assess the risk of illiquidity, meaning the risk for debt flows, which is debt service that we compare to revenue and exports. And we highlight that for some countries, while their debt stock is still sustainable, their debt flow is not. They have very high debt service that they cannot reimburse with their revenue or exports. So what we do in this analysis is to construct 4 groups based on this double perspective. So you see we have first a lower risk benchmark group with 30 countries. Then we have another group of 8 countries that are countries at risk of illiquidity with market access, so current market access. They've been able to issue in 24 and 25. And we see that for those countries, we have short-term relief, but medium-term risk. Then we have another group at risk of illiquidity, but this time without market access, so Eurobond market access. And for those 12 countries, we have a silent crisis, as we'll see. And then we have the last group, which are the countries at risk of insolvencies. So it's 8 countries. And the map below, you can see how, what is the geography of those different groups. having in mind that our focus at FDL is on low and low and middle income countries, and that for some countries we lack data, so we were not able to include them in our debt sustainability assessment. So this classification allows us to capture diverging trajectories across groups. And this is particularly true for net transfers. What you see on this graph are the net transfers by group in absolute value. So here it's important that you keep in mind that you should look within group at the trend and not across group, because we're comparing groups of different sizes. But here what's important is that we have a strong rebound in net transfers for lower risk. So external debt still finances growth here. For countries at risk of illiquidity with current market access, we see that access to the Eurobond market has provided fragile relief, because you have recovery in 24, the net transfers are back in positive territories, which is not what we observe for illiquid countries without current market access, which is the dark blue. The dark blue, we see that for countries that didn't get access to fresh money through bonds issuance, here you have still a downward trend, and net transfers are a net drain. External debt is a net drain, not a resource. And then we see that we have also no room to invest or grow for insolvent countries with slightly negative net transfers. So here our classification allows us to map different types of groups and different types of risk. Because what we see for our first group of the countries at risk of insolvency is that for those countries, the main challenge is really the level of debt stock, which is well above sustainable thresholds, above the 100% of GDP in median for this group. We also see that debt service is expected to more than double in 25 for those countries, and this only taking into account existing debt commitments, meaning that debt service will represent at least 20% of revenue in median for those countries. Then we also see in our analysis that foreign reserves are very low, so around just above the 3 months threshold, 3 months of imports threshold of the IMF, which means that they have zero buffer for shocks. And this is strongly important when we analyze the effect of the ongoing conflict in the Middle East. So for those countries, as we'll see with Martin, the only viable solution is credible debt relief to break the cycle. That is for the countries at risk of insolvencies. Now we look at countries at risk of illiquidity that have been able to issue on the Eurobond market. So they've been able to issue, they've been able to get some more liquidity, and it has allowed them to face the repayment walls in the short term. However, they've been able to issue at coupons around 7 to 10%. And this is strongly above the growth rates. So what we see, which is something that we show on the graph, is that this will be like the fact of accessing more liquidity is going to be paid by higher debt service in the future. So here we use forecast of the debt service to export ratio with our internal model, and we see that the illiquid market issuers are the ones with higher debt service to export ratio, plateauing, while for the other groups we tend to have a decrease and at lower levels. So here you really have a trade-off between easing short-term pressure and longer-term risk. Then finally, our last group is the illiquid countries without market access, which means, so if they don't have market access, it means that they don't have money coming from private creditors, because bond market access is correlated with other private creditors. And if they don't have access to private money, they have to go to the multilateral lenders. Hence, they will increase their share of senior debt. And on the graph here, you can see the share of senior debt between for frontier leagues and other leagues. So frontier leagues are using the IMF definition are the countries accessing the Eurobond market. And what we see is that we have a divergence between in the share of senior debt. So here, really, for the illiquid countries without market access, we have a doom loop of debt seniorization, because in case of restructuring, private creditors will be the last ones to get something from the cake. So it discourages future private re-entry. Then for those countries, we also have higher leakages from multilateral lenders toward legacy creditors, as I mentioned earlier. So really for those countries, the issue is that there is no, the money entering, so there is little money entering, and it cannot be used to finance growth. So we have a silent development crisis. So now you have a better idea of the different types of risk we highlight, and I leave the word to Martin.
Many things. So first, as you'll many thanks, Mélina, for this presentation. As you'll notice, I am not on the list of authors of this paper. Ishac Diwan was supposed to kind of wrap up this presentation and present the policy conclusion. Unfortunately, he had a last minute conflict. He up in the last minute. Couldn't join us at the last minute, and so I'm kind of the poor replacement of him in this talk. And I'll be very short because I think we have all the main elements in place. And then the question I tried just to lead to the panel discussions, which is what we highlighted risks that developing countries face, and those risks are now heightened and kind of magnified by the current war. Even with a ceasefire, oil prices remain high. And volatility will probably hamper the continued access to markets, and so a lot of those risks are kind of being are actually realized. And so, what does it mean for the policy implications and reforms? First, I think there's the insolvency frameworks and the fact that current framework need to be more appealing for countries that are close to their distress and that will actually try everything to repay when with a better system for debt restructuring, it would be more efficient for them to restructure and to negotiate with their creditors. So I leave them aside. The second group is the one that when we look at that sustainability analysis, we have this distinction between stock and flows tensions. And so, and within the countries with flows tension, with liquidity tension, I think we see really two different groups. Those which managed to have market access in the past year or two when markets reopened, and they managed with that, they managed to access liquidity when it was available. It was not cheap, but available. And they also show that they value highly the access to market. So for them, I think the goal would be to, if there is another extended time where borrowing is difficult and where the crisis of balance of payments are materializing, the goal would really to condition larger support from multilateral system with first ambitious reform plans and growth enhancing reforms, but also to manage to mobilize new forms of financing at lower cost and to move away from borrowing to other sources of capital flows. And finally, there's a third bucket which have not had market access and so have increased the recourse to multilateral lending and money with preferred creature. There, we think that it's time to use a more constraining more the stake for creditors than before, and to have a rule-based trigger where you cannot go above a certain level of senior debt. And that would condition flow relief, and that would allow other creditors to participate, both bilateral and private creditor, in a flow in a flow treatment. It's also, I mean, it also puts the importance of on bilateral creditors, which China is one of the largest, to think about how to moderate negative net flows, whether ambition to drive more FDI is feasible, and how to provide more support through different flows. I'll end there. Sima, back to you, and we can go to the panel cards.
Many thanks, Martin. So we will now indeed hear from our highly distinguished panel. We have the honor and pleasure today, which I'll be introducing the panel just now. So we have the honor and pleasure today to be joined first by Indermit Gill, Chief Economist at the World Bank, and whose data is absolutely critical to our work. Thank you very much for joining us, Indermit. We also have with us Ye Yu, who is a Senior Research Fellow at the Institute for World Economic Studies at the Shanghai Institute for International Studies. It's very late in Shanghai. Thank you for being with us today, Ye Yu. Ye Yu is also a member of the FDL Steering Committee. We also have with us Dr. Vera Songwe, who's the president and founder of the Liquidity and Sustainability Facility, and also a member of our steering committee. And last but not least, Benjamin Ramsey, head of EM Sovereign Credit Strategy at JP Morgan. And Benjamin, you're uniquely positioned to give us a sense of market views and sentiments these days. I will ask each of you to please keep your remarks to 8 minutes maximum, and I'll be strict in enforcing this, so you'll be hearing from me at the 7-minute mark. Mr. Gill, please, the floor is yours.
Thank you, Sima. Thank you very much. So first, I really like the paper very, very much. I think it's really well written and it's well documented, both. So I think that what it does is that it actually challenges our complacency and it actually pushes the debate in the right direction. I think that with hindsight, the report is actually very prescient, because what has happened since you published the paper, a whole lot of things have happened which have led to things likely things have been pushed in the direction that the paper feared, in a sense, right? So I'm going to organize my remarks around 3 points. First, what does the paper do particularly well? The second one is the kind of questions and tensions that it raises. And the third, what does it imply for policy, right? So I think that the central message of the paper is actually very persuasive, that 2024-25, that year looked better than 2023, but that improvement is shallow and is uneven and is potentially actually misleading, in the sense that it could actually lead us to believe that the problem is behind us or the problem is diminishing. And as but as the events of the past 5 weeks have indicated, that these things can turn around very, very quickly. Okay. So according to the paper, net external transfers turned marginally positive last year. So as some countries regained market access and headline debt ratios stabilized, they didn't stop falling, but they stabilized a bit, right? Because they had been rising a lot until then. Now, the paper also shows that a big part of these improvements are because of lower risk, because of the access of lower risk countries, while the illiquid ones and the insolvent countries actually remain in a problem of negative net transfers, with weak reserve buffers and with rising debt service burdens. That by itself is not a bad thing, because you do want countries that manage their risks better to have more access to markets and so on. But it also indicates that there is a huge problem that remains for countries that are not low risk or not lower risk countries. Now, but I think in any case, I think that that classification of countries into lower risk, illiquid, and insolvent countries, combined with this distinction between market access and no access, is very, very useful. So it basically is useful because it makes it clear that market access by itself is actually not a reliable signal of debt sustainability. So, issuing a bond at 8 or 9% can help with liquidity pressures, but it often worsens medium-term solvency. And sustainability would mean that you actually deal with your liquidity problems, but at the same time, at least not exacerbate longer-term solvency issues. Now, the other thing that the paper does very well, which we all sense intuitively, but we seldom see it so clearly quantified, which is that the rise in borrowing costs has actually has happened across all creditor categories. So this is not just a private creditor story. It's also the case for multilaterals and for the IMF and others. So that in some sense, even concessional finance is no longer cheap in the historical sense, right? I need to check those numbers again once, but I was actually struck by that. It actually makes us think too here at the World Bank. Now, so as a result, in any case, the effective interest rate on public external debt has risen sharply for virtually everybody. Okay, so that's the first part. Now, let me say a few words about the kind of questions and tensions that the paper raises, and I think these are very useful too. I think this is actually the more provocative part of the paper, and I think it's good. So I think basically what the paper shows is this clear structural shift that the first one is that private creditors and China are on net receiving resources from low and lower middle income countries than providing them. Okay, so that's clear. The second part, of course, is that multilaterals and the IMF have stepped into this breach, which means that the share of senior claims in total debt stocks has increased, right? Now, this has two implications. The first one is, of course, it creates what the authors call leakages. And the second one is it changes incentives, right? And I think that the paper does a very good job of both. Now, essentially, what it means is that this rising seniority protects official balance sheets in the short term, but it also creates increased expected losses for junior creditors. It discourages new private flows at least, and it can lock countries into this low investment, low growth equilibrium. And there's a problem with that because there's a secular decrease in potential growth rates across a broad swath of countries, okay? Other than a few countries in South Asia, actually, you see a decline in potential growth rates. Now, as a result of this, I think I would actually encourage the authors to engage even more explicitly with this, which is at what point does debt seniorization, stop being stabilizing and start becoming counterproductive? You're not going to get that analysis from the World Bank and the IMF and the thing, okay? You guys are going to have to do that. I will be happy to publicize it once you have it. But in any case, is there a threshold beyond which adding more senior debt actually reduces a country's ability to grow out of a debt problem rather than increase it? Okay, there is clearly a tipping point there. I think it'll be good for you to identify what are the correlates of that tipping point. Now, the other strength of the paper is that it sharpens, but it also complicates this distinction between illiquidity and insolvency. So conceptually, we know that the difference is clear, but in practice, it shows how blurred the line becomes once countries rely on high-cost borrowing to preserve market access. So I would actually say this raises a few questions, which I think are worth thinking about, which is how stable are these categories over time? The second one is how quickly do countries move from illiquidity into insolvency when growth disappoints or when another shock hits? A shock, for example, where you get a big increase in oil prices, and then as a result of it, instead of global growth being 3% for this year and global inflation being 3% for this year, you get a sudden decrease in expectations where global growth expectations drop to about 1.7 and global inflation rates under an extreme scenario can go up to 4.7%. So you get like a 50% drop in growth and a 50% increase in inflation. This can change things dramatically, right? And you can get portfolio outflows and so on. I think this is a serious problem, and I have a feeling that that problem is we are going to actually start to confront that problem not in years but in months or maybe even weeks. Okay, so I just want to end very, very quickly. Seema, I know you're looking at me because I'm almost out of time. So what does this mean? What does this mean for policy? I think one of the most sobering findings of the paper is the collapse in investment and growth among the illiquid countries. So median growth falling from about 6% pre-COVID to below 4% is not just a cyclical story, it's becoming a structural story. And finance, access to debt and so on makes access to debt and debt distress actually play a big part in this one. Now, which means that you have this important implication of the paper is that even when countries remain current on their obligations, the social and development costs can be enormous. So there's this uncomfortable message for a system where that still tends to equate no default is equal to success. That's not the case. Okay. And so as a result of it, I think that we stopped talking about the common framework, Vera, for a few months and so on. Not because the common framework was getting really, not because the common framework has become adequate, but because global financial conditions gave us relief in the sense that you actually found that these countries weren't going deeper and deeper into the sinkhole, But those things can change. Those things can change very, very fast. And we've also seen that the improvements in the debt restructuring frameworks, that progress is glacial. Okay, so I have a feeling that we're on the wrong side of these two changes again. That progress in the debt restructuring framework is still glacial, but the decrease or the worsening of global financial conditions has accelerated or will accelerate massively over the next few months, because you already started to see portfolio outflows from emerging and developing economies. They have become fairly sizable, and so you'll start to sort of see countries getting into trouble. I worry that we are not ready for it again. Back to you.
Thank you so much, Indermit. Thank you for these very rich reflections and for your feedback. I will now straight away give the floor to Yeyu. Yeyu, please.
Thank you, Seema, and thanks for the FDL invite me to join this very distinguished panel to share my comments on your excellent paper. And I also agree with Mr. Indermit, and actually I've also learned a lot from your paper, especially you deconstruct the data from the World Bank, the IDS data, and giving us a clear metric of how those low and lower middle income countries, actually we shouldn't be complacent about their debt situation, even though the global financial system, the interest rate of the US dollar is actually some improvement of the liquidity. So this gives us more, actually it tells more stories about the different countries. So I think it's very insightful for both creditors and also these debtor countries themselves. So, and for my comment, I'm especially impressed by your analysis on the composition of the creditors and their rules. So specifically, I would like to focus on the two creditors. One is the rule of the multilateral creditors. The other is I would like to also say a few words about the rule of China, because they are, I think, China is put together with the private creditors. So first, about the role of the multilaterals, I think you raise very sharp questions. On the one hand, their role is increasing, and this is aligned with the what we have seen, that the multilateral development banks are expanding in the recent decade, and actually that's what the shareholders and also the group, the G20, and also the borrowing countries all are pushing for the expansion of the multilateral institutions when the bilaterals are, as we know, that the international aid system is experiencing very sharp decrease. So that's the background. We have seen their increasing role, but actually your report pointed out this could be double-edged impact. And so this reminds us how should we see their role, because after the since the 2015, the SDGs agenda, they call for bigger role of the MDBs to crowd in private creditor. But actually, your report raised the issue that probably they will crowd out. So that's a point that's really impressed me. So I think in your report, it's probably not yet any evidence-based research yet. Just you raise the concerns. There could be a prospect could crowd out. So we have seen that those MDBs. I will not talk about IMF because they are more short-term, but about the MDBs. Those rating agencies like Standard & Poor's and also Modi as well, they have changed their methodology in rating those MDBs, providing them more space to expand. And the G20 actually has a triple agenda for the MDBs, so they are going to expand even more. And if they crowd out the private creditor, I think that's a big problem. So I think that's the first. Probably your report has the policy implication for those MDB reform, or how to really show to provide additionality for those low-income countries. And the second point about the rule of China, and I think not only your report, but also a series of reports from other institutions are paying much attention to the negative transfer from China. I think for because all these reports, including yours, focus on those Chinese policy banks. It's the official or semi-official those actors. I think that's true, and we shouldn't deny this one. And the reasons behind why they are, the BRI, and actually, I think there are two basic reasons. The first is that's the deleveraging process of the whole Chinese financial sector, so including their overseas lending. And the second, I would say that this is also related to the political, the geopolitics, and the Western world is pushing for decoupling from China. So actually, I think that's also part of the decoupling. And but I'm not going to stop here. I would like to encourage people to have a broader look at the Chinese rule. When the official or semi-official, those policy banks are decreasing their lending, actually the Chinese businesses are going up, are increasing, and so that's more about the FDI, those private sectors. Actually, that's also because of the yes, okay. So just to be short, to be brief, the share, I saw your report, the Chinese share in the total total debt in the low income countries is about 6%, and Chinese FDI in the world, the share of Chinese FDI actually has been increasing every year when the world FDI is decreasing, and the share has increased from let me see from 10.5% in 2021 to 11.9% in 2024. So the Chinese business are speeding up, are accelerating their going out. Actually, that's also related to the geopolitics because the decoupling from Chinese mainland. So they're increasing their industrial transfer, the shift from the mainland, their supply chain to those global south countries. So I would say this is a good thing if you look at this one, because I don't think China should repeat the story of those OECD countries when they strengthen the regulation on the ODA, and this causes sharp declining of the Japanese financing. So I think we should look at the development finance from a broader scope. So just let me stop here. Thank you.
Thank you. You're perfectly on time, Yeyu. Thank you for that. Dear Vera, Dr. Songwe, please come in. The floor is yours. Vera, you're on mute.
Sorry, haven't figured it out yet. You can hear me now. Sorry, it's a pleasure to be on this panel with old friends, and really to start. Let me start also by congratulating Ishac, Mélina, and Thomas for, I think, what is a very, very enlightening report, and of course Martin and Simmer, and then the whole FDL crowd, of which I'm a member. For this piece of work. I think it's building. We started this conversation on illiquid countries, non-solvent countries, 3 years ago to 2022. And then I think that there was still some debate about whether it was the right classification. Should we even be talking about it? Is everybody just insolvent? And so I think that this piece of work is really a very rich contribution into that debate, because not only have you gone into saying, yes, there is actually a category of illiquid countries, but you have now sort of provided an even better distinction between sort of illiquid market access and illiquid no market access, and what we should be doing with them. And then, of course, the low income countries. And I think it's very important to look at it that way, because as we said, and as Indermit also said, we all live in places where, everybody needs to say something very quickly, as you're giving us only 8 minutes. And so in 8 minutes, the headline is, oh, net negative transfers have stopped and everything is better. And then everybody feels happy and goes away. And I think what the report shows is, no, that's not true. That big headline is a great headline, but there are huge variations internally, which require a little bit more attention. And I've always said that the right diagnosis is almost 60% of the solution to the problem. And if we don't have the right diagnosis, then clearly we would have the wrong solution. So I think this is a little bit the laborious work of unpacking it and then sort of being able to see what remedies you give to each of those sub categories. So I think that's one, and I'd like to now go to two pieces of discussion, which are essentially, the report does a fantastic job of sort of unpacking the data, who is doing what. And I think this is sort of the next step of the report is, so what? We now have all this data. There is a lot of conversation around it. What more can we do? What can we say? And since Indermit is here, what can the MDBs do better and stronger, and what can the countries also do more and better? And I'd just like to maybe structure my thoughts then around sort of 5 recommendations that I think that, one, maybe some more work that the report can do, and there is a lot. I think if there are any students on the call or people who are interested in these pieces of work, the report really lays out so many new avenues for more work. Clearly, there is a lot more work that's needed, and I think hopefully that we will continue to do that. But let me go back to something that we've done a lot of work on at FDL, which is the bridge. And I think that the report actually, when we started the conversation on the bridge, which was essentially this, yes, there are a series of illiquid countries. We should not wait for them to go into the common framework. And I wasn't going to mention the common framework, but since Indermit mentioned it, I'll come back to it. But at the time, the suggestion was, let MDBs put some resources in. The creditors then should come in, coordinate themselves, not take money out, but bring more money in. And countries should do good reforms. So this was kind of the bridge conversation. You bring everybody in and you have better outcomes and higher growth. What I think the report is showing is that even in the context of the bridge, we do need to look at the bridge for illiquid market access countries and the bridge for illiquid no market access countries. And that actually the bridge solution should be different or must necessarily be different. And this is then the second part of my suggestion, is that I think that for the illiquid no market access countries, what we need to look at is, can we do something a la EU, where a lot of the illiquid no market access countries are too small to go to market, right? And so essentially, if you want to go to market, the market will only wake up if you are at 250, and even now maybe less, 300, 400. But that's too much for a Gambia. It's too much for a Niger. And so do we want to do a pooled fundraising for all of them, right? Is that something that we could think about? Then I was saying to myself, who will do that, right? Is it the African Development Bank? Is it the World Bank? Is it a consortium of MDBs that come together? But I think this is something that we may want to think about, which is a pooled market access. But then it goes back to the same bridge a triple agenda or framework, right? Which is MDB money, but pooled MDB money this time around. Creditors that sort of agree that they will coordinate themselves. And so we need to understand who are the creditors. Most of them actually are the MDBs in the illiquid no market access countries and some ECAs. So slightly, maybe coordination is slightly easier in those ones. And then, of course, reforms. But a lot of the illiquid no market access countries have also been doing good reforms. So that's one suggestion, which pushes a little bit, continues the differentiation, but pushes at least, I think, the 3-pillar approach, which the World Bank and the IMF are already sort of doing. The second suggestion that I thought was, and Indermit sort of stressed that a lot in his closing, which was that market sentiment is worsening. And so maybe even those countries that we call illiquid are going to get into a lot more trouble. And I was wondering if we could use a similar approach to what we're doing on climate, where you almost have state contingent debt payments, so that if you have a shock like we've just had, right, then maybe we can say, we suspend the rates in the United States for the first time. There has not been this flight to safety, so even the US has become more expensive because people are also leaving the US, and so rates have gone up. And so I just did some calculations working with the FDL team. And so debt payments for the continent will go up by 4.4 billion, additional 4.4 billion. can we do something that says that if there is a 1% or 2% sort of systemic increase in overall cost, that, maybe we can, almost like a DSSI, you extend the maturity of payment of that portion, right? So 1 minute. So that's the second thing. And okay, so we can work on that. The third one, of course, is market infrastructure. We do need to do a lot more work on sort of just providing better capital market infrastructure for those countries so that the cost of capital is lower. If you can create secondary markets, we know that with the creation of better secondary markets, the cost of capital will be lower. And the third one, which we have been talking about for a very long time, is domestic local currency debt. And I think in the next piece of this paper, we need to do a little bit more work on what is now happening with that dynamic and can we transition to it. Thank you so much. And of course, there's a lot of other things we can talk about, but these are just some areas of discussion that the paper, makes me think about and more work that we can do. Thank you.
Thank you so much, Vera, for giving us these future pathways of work. Benjamin, the floor is yours. Please come in.
Thank you very much. It's a pleasure to be here. It's a pleasure to be on this distinguished panel, and I really enjoyed the paper. It was very thought-provoking, and I also have very much enjoyed hearing my fellow panelists' comments here at this session. Let me make a few comments that struck me about the paper, and you're right, I may take a little bit of a different tone than on the panel, being closer to market participants as a researcher here at JP Morgan's Emerging Markets Group. I should say, as per my compliance department, that these comments are my own and don't necessarily represent my institution. So I think, there's some sort of broad assertions that are put forward, which make sense and make intuitive sense that, rates are now much higher and that's unsustainable. And yes, they've come down, but this feels like it could be fleeting and we may see rates go up again. Sort of broad assertions that, issuance approaching in the bond market approaching 10%, is something unsustainable, and that's going to condemn that issuer eventually to defaulting on that bond. And maybe even before I start my comments, I appreciated what Vera said, because I think we do have to sort of distinguish here the groups here of countries which have had access to the bond market and those which haven't. And in the paper, there is a sort of a lot of discussion in terms about the private flows coming in associated with the bond market, the Eurobond market, but really only about a third of the countries in the database of the report are those which have gone to the market before or have market access. So there's sort of 2/3, which I do think we kind of have to think about differently. But that said, if we do think about the sort of market access countries and those which have issued, which are the countries that I'm, the ones that I look at, I think we have to be careful when we think about those broad assertions, but also what that means for debt sustainability and sort of debt dynamics. So if we think about, the equation, just to think about what is sort of the variables which will stabilize or destabilize debt dynamics, and it's sort of that interest rate that you're borrowing at versus growth, the sort of famous R minus G. I think we have to take caution to either think about those in real terms or in nominal terms, but let's not be thinking about low real growth and high nominal rates, because we have been and we are in different regimes right now. So I took a look at the market access for roughly 20 of the market access countries, which we have data for sort of our JP Morgan's MB sub-indices, and looked at their nominal growth rates and looked at the yield to maturity on their Eurobonds. So if you look at that in the period of 2014 to 2020, so sort of taper tantrum end of the global commodities super cycle up to the pandemic, of those 20, GDP weighted nominal growth on annual average, on average was about 2.4. Simple across those countries was 1.9. So roughly 2% nominal GDP growth. It's very low. And the yield to maturity, as was discussed, was around 7%. So we sort of had an R minus G, which was approaching 5. If you look at the period after the pandemic, so 21 to 25, where we've had a much higher rate regime, yes, yield to maturity on those same countries has gone up by 370 basis points, so above 10.7% in that period. Nowadays, we're closer to 8 because we've rallied a lot since the 22-23 period. But nominal GDP growth averaged something closer to 4 In a GDP weighted 3.6, and a simple average across those countries 5.5. So the R minus G equation, if we're going to think about that in nominal versus nominal, because we're focused very much on the nominal rates, is actually lower. It's 4%. So yes, it's still your R is above your G, and this is not stabilizing for debt dynamics, but it's not necessarily, there's a reason why we've actually seen stabilization in debt dynamics. And when I'm talking about nominal GDP, I'm talking about in dollar terms, just to be clear, because we're also talking about borrowing rates in dollar terms. So I'm not talking about local currency. So I am incorporating here any type of real depreciation which would have taken place to impact that level of nominal GDP growth. So that's just the one point I wanted to make. I think we really should be thinking about the G, not just the R, and we should be thinking about real versus real, nominal versus nominal, if we want to think about debt dynamics. The second point I wanted to make about this sort of 10% magic threshold is that we, clearly we haven't seen many countries borrow at that rate in the last 20 years, when either EM dynamics were very strong up until the GFC, or when we sort of had this period of ZIRP, zero interest rate policy, which kept treasuries very low, got spreads very low, and allowed borrowing costs to be very low. But if we look at the sort of first third of the world of EM Eurobonds, Brady bonds into Eurobonds, so this period of 1995 up to 2004, and we wrote a paper on this on our team a couple of years ago. They were actually, so at that point, the treasuries were, 10-year treasury averaged about 5%, so higher than where we are today. There were 18 different issuers that issued 120 different Eurobonds with an average coupon of 11.5%. Of those, 20% of those bonds defaulted, but only 3 of the 18 issuers defaulted, and they're well-known names: Argentina, Ecuador, and Venezuela. If you then go and look at sort of what happened if you flash forward to more or less now in terms of those countries which issued at those levels, you do see that about half of them are still nowadays rated single B or C. So they definitely, issuing that high rate, whether it's causal or not, didn't end up allowing them to improve their credit profile. But the other half of those, you have 5 which are now investment grade, and 4 which are double Bs. So I just don't think we can sort of necessarily say that definitively issuing at 10% is going to condemn you to one path or the other. The other part of the debt dynamics equation is the fiscal, right? And that's the one which the country, alongside reforms, has the most agency over. So, I mean, that at the end of the day, the countries, can and have the ability to sort of set their own paths if they make the right policy choices internally. And then finally, just in terms of leakages, again, I think we kind of have to make some distinguish a little bit about where those leakages are going to, because when we get to the leakages part of the paper, it is kind of acknowledged that bond markets have come back. So where the leakages are going to the private sector, and I agree with the comment from Yeyu that thinking about China, we have to be careful about what's commercial and what's not commercial. But what are the reasons for leakages going either to China or export credit, banks, suppliers? And these different private sector actors may have different incentives in terms of why they would roll over or not roll over. It may be geopolitically strategic. In terms of suppliers, I'm not sure you want to not pay for goods and services that were delivered to you and you're running arrears on, because that supplier is just going to charge you more in the future, expecting that they're going to get restructured in the future. And I guess that sort of goes a little bit to the point of this idea that seniorization is going to crowd out private lending. On the bond market side, I don't see that in practice. I mean, no, in the primary issuance, maybe in the secondary market, if you're buying a bond that's distressed, you'll think about what your recovery value is going to be, and if it makes sense to buy a bond at a certain distress level. But in the primary market, nobody's investment thesis, lending 100 cents on the dollar, is that I may get 40 cents back versus 30 cents back. And so it's really about if the lending is there helping a country to cover its financing gap, and that makes the profile, the credit profile of the sovereign look sustainable going forward, then that will be incorporated into the yield that gets charged. But I don't see that sort of thinking about the default end game in terms of primary bond issuance being part of the equation of an investor's investment thesis. So I'll stop there. And again, thank you very much.
Thank you very much to our panel and panelists for these very rich remarks. We now have about 15 minutes left for questions and answers. We already have a few that are posted in the chat, sorry, not in the chat, in the Q&A function. Please do use the Q&A function to raise any questions that you may have. I will start with Anaï Windenbroek's question for FDL, since this addresses the findings of the paper that Mélina presented at the outset. So Mélina, this question is for you. There are actually 3 questions, but feel free to see how you want to address them. First is, what is your reading on the why or the reason behind the sharp increase in interest rates of bilateral debt in 2022, and what explains this? What are the drivers? Second, more fundamentally, how do you define market access in your model, in the FDL model? And lastly, you mentioned that we need common framework reform, including all creditor classes, but exclude multilaterals. Could you please build on this and explain your thinking there? So let's start there, Mélina.
Okay. Okay, perfect. So first, many thanks to everyone for the feedbacks. It's really great to have all your views. Thank you for the question also. So let me start with the more technical question, which is how do we define market access in the paper? So in the paper, we chose to define market access as the countries that have been able to issue a sovereign bond in 2024 and 2025, assuming that after that the market was closed in 22 and 23, most countries that used to access markets did so in 24, 25. We know that it's you might be able to use different definitions, so it's something that we want to refine also in future publications. But in this publication, this was our take. Then, regarding the rise in bilateral interest rates starting from 2022. So first, you have a change in the global interest rate levels with the tightening of monetary policies globally. You also have a decrease in official development assistance, meaning that you have more loans instead of concessional financing. And you also have a change in the recipient countries. So you have less poor countries receiving really cheap financing and more, let's say, not middle income, but like bit richer countries, which are not given official development assistance, but loans. Here, that might be a first part in the explanation of the rise in the bilateral interest rates. And I would say that for the last question, the one on the common framework, if I'm correct, Sima, I would tend to give the floor to our panelists because it would be, I think they might have a very interesting view. So if someone in the panel wants to take it.
Yeah, so maybe just a reminder, the question was that the paper mentions the need for common framework reform, that would include all creditor classes, but that excludes multilaterals. So I don't know if Indermit or Vera want to comment on this.
I'd like Vera to comment on it because my view is, of course, it should exclude the multilaterals. Yeah.
Thanks for clarifying. Vera, do you have any thoughts to share?
The only part of the thing that I didn't mention at the time that I spoke was this policy that's called the Sustainable Development Finance Policy of the World Bank, actually of IDA. So this is for if a country gets concessional loans from the World Bank, it signs an agreement that it would not actually access markets without, except under exceptional circumstances that have to be cleared ex ante, not ex post. If you look at the World Bank's page on the SDFP, you won't find it there. You wouldn't find that condition as clearly as I laid it out right now. Okay, it talks about all kinds of other stuff, but it doesn't make that clear. And so then you sort of say, okay, why is this the case? Are we taking our SDFP policy seriously? And the answer, I think, is no. I think that these countries tend to get concessional lending from IDA as well as from the other multilateral development banks, and then go ahead and borrow abroad too. So I think that this needs to stop, basically, because I think it creates all kinds of distorted incentives. So that's one thing. I'm sure that Ben doesn't agree with me on this one. But it makes no sense at all to actually, I mean, the country should take the SDFP seriously, and so should the World Bank. That's one thing. The other thing, I feel like on the common framework, we've gone over this in the sense that so if you remember that if you go back to the highly indebted poor country initiative, it was the first part, the highly indebted poor country initiative excluded the multilaterals, okay? And then it was found that these countries needed debt relief also from the multilateral development banks, because without that they would not come back to a sustainable public debt to GDP level. So you had the multilateral debt relief initiative as a result of that. Now, one shouldn't go back to that world, because since that time, the multilateral development banks have made their lending a lot more concessional, shifting to more concessionality and even to grants for many of these countries. So in a sense, a grant is ex ante debt relief, okay? So in that sense, these countries shifted rather from going to ex post debt relief to ex ante debt relief. So once one calculates that, you actually realize that there is that rationale for excluding the multilateral. The other rationale, of course, is the multilaterals are the only ones bringing new money in. So you want the multilaterals to bring new money to these countries. Otherwise, they tend to have huge development effects and political instability effects and so on. So if you look at the multilaterals right now, they're the only ones with net positive inflows into these countries. Yeah, but let me stop.
Thanks very much for these reflections, Indermit. Vera, I see you unmuted. Did you want to come in?
No, I just wanted to say that I agree with what Indermit said. I think the multilaterals need to stay in. They just need to do a little bit more. And so essentially what we see now is that the multilaterals are doing just enough so that the country can pay back. And so essentially that investment portion is still left for nobody. And the argument really is that the multilaterals should be focusing on the investment part. And so we do need to find out how we go over and above just paying back creditors to then having a portion that is purely investment. And that is when in the sort of bridge conversation, if we were able to get a coordinated framework that maybe as we reinforce the SDFP, we also reinforce investments in new infrastructure, right? So we will only disburse if you're actually going to build that road, not that you're going to use the resource. And if you don't build that road with disbursement T, then you don't get disbursement T+1 kind of thing. If you put those kinds of conditionalities, which we can do in a coordinated way, then I think you begin to get, the conversation that moves, because the unfortunate part about those conversations is that we are just stuck with debt. We're not talking about investment and growth. And that is, I think, what Benjamin, if we are not growing that denominator, we are not going very far, right? Kenya did all these rigmarole things, And in the end, they are still 67.8% debt to GDP. They went from 68 to 67.8 after having borrowed $4 billion. That is the tragedy of the conversation. So I think we do need to figure out how we can go past just discussing debt and debt service to, can we actually put some conditionality that takes us to investment?
Agreed. Now, so two things, Vera, on this one, if I may, Seema. The first is, we are the World Bank Group. For example, we are not just the World Bank. So you'll actually see that IFC has become much, much more active in trying to sort of mobilize private capital for these countries, both internally and externally. So that's one thing. I think that you'll actually see that, given the fact that these countries are actually fairly sort of so because they are at very
Their
high
market access, yeah.
ratio, even private debt to GDP ratios have increased a lot. So equity finance, etc., especially for the private sector. So that's one. The other thing that worries me about this, Vera, is that if you sort of look at the charts from the International Debt Report and so on, you'll actually see that most countries have increased domestic debt issues massively, right?
That was my point, exactly.
Yeah, and now that has two problems. Of course, sovereign governments tend to have access to external funds. Firms don't. So as a result, you crowd them out when you go into their market. And then the second one, of course, is the other thing is that these issues are actually much shorter term. So now you're much more vulnerable to the vagaries of the market very, very quickly. So both those things have happened. So I think that also has to change. But the thing that I feel that what has to change, Vera, also is a sense especially in sub-Saharan Africa, but elsewhere too. Like, a finance minister doesn't feel like he's a real man unless he goes and borrows abroad, I mean,
I think this is true for Pakistan, for Egypt, it's true for everybody.
Yeah. No, I'm saying it's not just Africa, but I mean it's everywhere. But the thing is that even countries that have gone into debt distress, the first sign of success is, well, I access external markets again, rather than saying, here's how I improve fiscal policy. I did this. Let markets come as they want to. So I think that's the part that I worry about.
But this is the part, Indermit, if I may, and then I'm going to have to go. But I think that part of it is the issue around also the robustness. Let me just finish 1 minute. The robustness of the macroeconomic frameworks that we provide. If you look at right now, I'm reading the latest IMF report on Egypt. I don't believe any number in those projections. Right. And they do it because they're trying to provide a little bit more fiscal space so Egypt can go and get another 6 billion. But there is no reform framework that is robust and consistent enough. And in some sense, I think that if we had a stronger coordination process between MDBs, creditors, and countries on the reform agenda, maybe not a big ambitious reform, but at least a few things that you actually do, I think we will be going much further than we are now. Now we have and we saw that with Kenya, right? We've just lived it with Kenya, for example. But I think we are all agreeing with each other, and Seema wants to shut us up. So
no, I don't. I actually wanted to build on this to bring in a question of a participant.
I have to run.
Which is okay. Well, thank you so much for joining us, Vera, and much appreciated that you could give us some time. We'll take maybe another 2 questions. We have quite a lot of questions coming in. Let's take another 2. The first one was asked very early, and it's about Senegal and the use of total return swaps that Senegal recently decided to go for debt management reasons. So if anybody on the panel, Martin, perhaps yourself, have some views about this, please do come in.
Okay, very quickly, because we're out of time. I think the use of those kind of financial instruments, I mean, that's kind of started to generalize. I think it's also part of the World Bank report, and that creates real tension because those tend to be collateralized with domestic debt, and so this can dilute the holdings of other creditors. So that will complicate things both from liquidity and solvency point of view. So understand when countries rely on it because of its kind of last way when liquidity is scarce and when there are clear tensions on solvency. But it's not, I mean, I think ultimately we hurt its kind of prospects going forward. I think there was a question on what tools to use and what we think concretely about when we say, for countries with no prospect of market access. I think the IMF has tools that it develops, especially around your kind of post-crisis for countries where that is sustainable, not with high probability. They develop this concept of a gray zone, where basically part of the requirement would be that other creditors stay in through rescheduling, and that hasn't been used at all. And so finding ways to use it, I mean, especially for countries where market access, when you lose market access when you're scheduled. So when prospects are lower, I think it's something that really should be explored more. Those tools exist. They've been approved broad papers. Just a question of implementing it. And I just want to I mean, think all, I think what great questions on the role of bilateral and on the differences between kind of the type of flows I think those are very well taken, and I think this shift, better understanding this shift from lending to FDI and value chains is very important, and that's something we really want to work on more. And I think to Ben, I think it's a very good point. I mean, the key question is how kind of this home energy question and how to raise growth level, and then how this is part. I mean, there's a portfolio approach, and that's why we're not. I mean, I think we try to argue that the market access was a good thing, was the thing that helped countries rebuild their reserves, their liquidity when they had the opportunity. But it adds also challenges in the long run if growth collapses or declines and rates are fixed and high. And yeah, sorry, I didn't mean to take the floor. If you want,
let me just comment briefly on the I guess the Senegal question, and I'm not going to comment on the merits or not of total return swaps per se, but in terms of policy recommendations that we've been hearing consistently since, particularly since the Global Sovereign Debt Roundtable has come into being after the common framework, as a sort of complement to the common framework, this idea of preemptive treatment when something clearly looks like it's not sustainable, and then the issue here of how do you compel that to happen. So I mean, the policy recommendation on paper looks perfectly reasonable, but in practice it just seems like it continues to be something which is difficult to affect, and I'm not sure. And I think that is an issue that I think I see, unfortunately, with a number of the sort of theoretically sound policy proposals that continue to be out there broadly when we think about this architecture.
Thanks very much, Benjamin. Maybe just one very short minute left to address one very last question, just because it's so timely. There's a question from a participant asking whether the ongoing situation in the Middle East, which I think until now we haven't really properly addressed, and oil prices are expected to widen divergences between country groups going forward. Maybe if one of you could take that question, and then Martin, if you could just wrap everybody up for today.
I could briefly say what's happening in the Gulf is not a good thing. It's not going to have any good effects, I think. So I think the first thing is, of course, is that it's going to increase interest rates, or at least it'll slow down the decrease in interest rates, because it will create inflationary pressures everywhere in the world sooner or later. And then as a result, a lot of the policy rate discussions will change. So that's one thing that'll happen. The other thing is that if it lasts long enough, and given the fact that it's just not an oil-related disruption, it's also natural gas and minerals and aluminum and everything. So as a result of that, what will happen is that you'll get a slowdown in growth, especially in Asia. So especially in South and East Asia. And this is the workshop of the world in many sense. It's also the place where you have a lot of exports of rice and other food grains. And so as a result of that, you'll also get an increase in food prices sooner or later, because fertilizer prices are going up already. So as a result of that, I don't think it can be particularly good for countries both in Asia and in sub-Saharan Africa, which are especially those that have high levels of debt, and that will actually struggle with food import affordability and things like that. So my own sense of it is that we are back in the 2023 world, at least. It's not the 2024 world anymore. Yeah.
Good words on which to end.
Maybe that, the only thing I want to add to the difference between 22, 23 and now, when we obviously saw a very sharp increase in oil prices, when we think about market reaction, is that we were coming out of ZIRP at that time, right? So we had a very also disruptive change in global interest rates as the Fed hiked 500 basis points and as treasuries rose 300 basis points. So we're now in a world where, yeah, maybe monetary policy is on the margin going to go in a tighter direction. That can be problematic, but we're not going to have the change in sort of going from negative real interest rates to some sharply positive real interest rates in the course of a year. And that is an important difference.
Thanks very much, Benjamin. Martin?
Yeah, point taken.
No, I think want to also to thank everyone for participating early in the morning or late in the evening, and just to say that we are going to continue this work, which I think we kind of expect a lot from I think the multilateral system, and see a bit what the spring meetings can bring in ways to mobilize for in this situation for the European countries. So it's something we hope to continue to work on, bring ideas, and see how the multilateral system can react.
Thanks, everybody.
Excellent paper. Keep it up.
Thanks
Keep
a lot,
up the
Indermit.
great work. Excellent paper, guys. Yeah.
Thanks a lot, Ben. Thanks to you.